Hello, this is Mike Swanson. I run the website WallStreetWindow.com. And today I want to talk to you about some recent developments in the financial markets and how they're impacting the trends and gold. Did my last video about gold, and gold is soaring, went to all new time highs just last week. The GDX Gold Stock ETF is doing better this year than even NVIDIA to be the top sector of the entire market. Uh, but I got an interesting email question from one of my newsletter subscribers, and that is, how much gold does one actually have to own to protect themselves from inflation, to protect themselves from the possibility of the US dollar index declining more in value? So we'll get to that in just a second. First, let's look at the news items of importance. And of course, it's the August monthly payrolls report on Friday. They were much worse than expected, and even the unemployment rate ticked up a little bit. And the odds of more interest rate cuts from the Federal Reserve jumped up substantially. So this is an article on Seeking Alpha. You can see last month only 22,000 jobs were created. That was a decline from what happened in July. And you can see last year, there were like 10 times as many jobs created every single month. Now there's much less. That is a sign of a weakening economic situation. You know, whether that's going to become a recession or not, I don't know. For the short term, it's not really that important to know that in regards to the financial markets. But of course, the unemployment rate has also ticked up. And the odds of an interest rate cut happening at the next Federal Reserve meeting scheduled for September the 17th are now, basically 100%, with an 89% chance of a 1/4 rate cut. But what has really changed is the pace of cuts after that. Before last week, we were really looking at the odds were a one rate cut after the September meeting between now and New Year's. Now it's one cut every single meeting, but the path isn't that much different from what it was a couple of weeks ago in expectations of the Fed fund futures. And that is a move down to uh, basically a 3% to 3.25% interest rate, 1.25 points lower from where it is now. And not coincidentally, that is the target I saw mentioned by the Treasury Secretary Scott Bessent in an interview he did. I think it was with Bloomberg, and he's essentially, now taking control of the Federal Reserve on behalf of the Trump administration. He interviewed potential Federal Reserve chairman candidates to replace Powell next year on Friday, and they're replacing two of the board members already. So they're taking control. They're going to get those rates low as they want them to get in order to help finance the U.S. budget deficit, which is the stated goal that Bessent has made. Of course, when you have the stock market at all-time highs and inflation above 2%, closer to 3%, interest rate cuts are going to continue to stimulate the financial markets to help them go up more or increase the valuations even more astronomically in bubble territory, depending on your perspective on that. But it's also going to lead to a weakening in the US dollar index, which has been a trend all year. US dollar index is almost down 10% year to date. And of course, here's the price of gold. You can see the breakout for 34.50 that really happened the first trading day of September, and gold looks to be making another leg up. I think it can hit my $4,000 an ounce target by the end of the year, which is going to really mean even bigger gains for mining stocks. But that's just talking about the gains. I do own gold, and here I'm talking about, oh, it can go up, it can help you make money. But what about, forget about trying to make money, forget about speculation in that sense. what about how much gold do you actually need to protect yourself from inflation? Because I'm not telling anyone, I'm not doing it, to put 100% of one's money in gold. I know crypto gurus, many of them are telling people, put all your money in crypto, and Bitcoin is safety, and all these little speculative coins is where you want aggressive investing. That's madness, absolute and utter madness. In fact, anyone, I don't care who they are, who tells you to bet all your money on one thing in the markets, whether that's stocks, bonds, gold, crypto, another market, whatever, to bet all on one thing, anyone with common sense knows that's not what you're supposed to do. You're supposed to diversify your bets. So there's no, to put 100% your money in gold, you don't need to do that to protect yourself from inflation and the falling value of the dollar. So how much do you need to do? Well, generally speaking, history shows that when there is a period of time, such as the falling value of the US dollar, gold typically goes up at twice the rate that the US dollar index declines. So if you think, there's no need then, if you think of the most extreme scenario, and I don't believe it's going to happen, but say the value of the dollar went to zero, how much gold would you need to own in that case? Well, actually, the answer would be 50%. No, it would be 33%, because the value of gold is going to should go up at twice the rate the US dollar index declines. So if the US dollar index went down to zero, you wouldn't need to have 100% of your money in gold just to protect yourself. You would need from the falling value of your other assets priced in dollars. You just need 33%, not 100, not 50, 33%, because you can expect your gold to go up twice the rate of the falling dollar. I don't think the dollar is going to go down that much. I don't think we're headed to such an extreme hyperinflationary scenario. But if we think to the 1970s, which is a more likely model, a stagflationary decade of weak economic growth, and we actually do have weak economic growth right now. The unemployment numbers demonstrate that's the reality. Doesn't mean we're in a recession. It means that we are in a weak economic growth environment with inflation almost as high as the last official GDP number, and it probably is higher as we speak now. That's stagflation. That's what happened in the 1970s. And there are huge US debt problems in the 1970s that were inflated away. It didn't take the dollar going down to zero in value. The US dollar index fell by roughly 50% in value in the 1970s to European currencies, to the Swiss franc, and more stable currencies of that decade. And I think a similar move could happen here over years, not over months, not over weeks, but over a couple of years. And if the US dollar index fell by 50% and one wanted to simply protect themselves from that by owning gold, you'd have to own 1/3 of 50%. That's roughly around 15%, give or take. It's like 16% or so, but give or take, around 15%. So as we came into a couple of years ago, I decided to put 15% of my money in my brokerage accounts in metals ETFs. Now I've increased that number. I actually increased it dramatically last year in the first quarter around and started doing YouTube videos, banging the drum on getting into gold and precious metals and silver before silver broke out of $26 an ounce, and now silver's at 40. So it's been a great investment bet in that regards to me. But initially, I only had about 15%, and I'm just saying that's one figure. If the U.S. dollar index fell in value by 33%, you would need to own 10% in gold or metals. And if it fell by 10%, you'd only need 3%, which is what's happened this year. And you can see gold has gone up much more than 10%, which is about the US dollar index has fallen. So those metrics, those that sort of 2-to-1 relationship of has held in place this year, and it's matched not only what the U.S. dollar index did in the 1970s, but what currencies typically do against gold when their currencies decline. Get the Ray Dalio book about the debt crises and how he has all the historical data, and you can see that. So that's what I want to talk to you about gold. Now let's get back to the financial markets. One other thing I wanted to mention with you, besides the move in gold, this was the most significant move, I believe, in a market. This is the TLT ETF. It tracks the value of U.S. Treasury bonds, in this case, the 20-year Treasury bonds, and it had a sharp rally on Friday following those job numbers. The LQD ETF, which also tracks high-grade corporate bonds, jumped up. The junk bond ETF also jumped up. This is significant for me because while the U.S. dollar index is declining right now, the bond market is not acting as if we're in some sort of debt crisis. I do think one is likely to happen down the road. When it does, the value of U.S. bonds will decline. That's what happened in 2022. Bonds fell, dollar fell, stocks fell. It wasn't a debt crisis, but there was worries about inflation and at times the U.S. debt situation. But right now, bonds are going up. And as long as bonds go up and stay bullish, I'm not going to be bearish on the U.S. stock market. I think that bond rally is really the one of the big drivers of the gains in the stock market. In fact, and as long as the LQD and corporate bond ETFs continue to rally, I think the stock market is going to be okay. But one day the bonds will go into a bear market, and then it will be something to worry about. But as it stands right now, as I'm doing this video, doesn't look like that's not the trend right now. And honestly, I'm someone that does not predict the future and then makes bets on predictions I make or anyone else makes for that matter. I invest in trends. When it comes to gold, the trend is clearly up, and it's been up for quite some time. When it comes to the U.S. dollar index, the trend is obviously down, trading below the 200-day moving average, and bonds just popped up. So those are the trends. I stick to the trends until they change. And if you want more videos like this from me, hit like so I know. I stopped doing videos for about a year, so encouragement will get me to do more of them. And subscribe if you're new to this YouTube channel. And if you're new to me, get on my free newsletter by going to WallStreetWindow.com.